Welcome back to Cruising Through the Numbers, the CruiseLine ShowDown.
Hi, I'm Chloe.
And hi, I'm Scarlett.
In our last episode, we talked about who Carnival Corporation and Royal Caribbean are, what they do, and more importantly, how they make their money.
Today, we're diving a little deeper though. We're crunching the numbers to see what their financial ratios reveal about how these two cruise ships manage their money and how strong they really are.
Let's start with liquidity, or basically how easily a company can pay its short-term bills.
Yeah, so like in other words, like how fast or easily you can transfer like assets into cash. There's actually two main ratios we're gonna look at, and that's gonna be the current ratio and the quick ratio.
First up, let's compare current ratios. Carnival Corporation's current ratio improved slightly over time, going from 0.66 in 2020 up to 0.83 in 2023, while Royal Caribbean, on the other hand, was a bit tighter, with a current ratio of 0.35 in 2020 and only up to 0.44 in 2023.
So even though both of them are below 1, which means like your current liabilities are greater than your current assets, Carnival's liquidity position is still a little healthier. It's important to note that the quick ratio should be equal to or greater than 1, meaning that a company would have enough assets to meet their short-term obligations in the current moment if they need it.
And when we look at quick ratio, which removes inventory and focus only on liquid assets, both are still low, showing that they rely very heavily on future bookings and cash flow to cover short-term obligations.
For example, like Carnival has a quick ratio of 0.59 in 2020 and ends up at 0.78 in 2023. Meanwhile, Royal Caribbean starts with a quick ratio of 0.3 in 2020 and finished with a quick ratio of 0.4 in 2023.
You can see that their quick ratios are still not the best, being under 1, but it looks like they slightly get better after COVID.
In short, both companies are sailing pretty close to the edge with liquidity, but Carnival still has the slight upper hand.
Next up, we'll look at efficiency, or how well a company uses its assets to generate sales.
We'll look at inventory turnover, days sales in inventory, and days sales in receivables.
Inventory turnover for Carnival averaged about 25 times per year, compared to the 18 times for Royal Caribbean. That means Carnival was selling through its onboard goods and supplies faster than Royal Caribbean does.
And efficiency matters. Selling through goods and supplies faster helps reduce waste, and it keeps cash flowing. However, when it comes to day sales and receivables, the average number of days it takes for a company to collect payments from its customers after sale has been made. Carnival Corporation has the slight upper hand, collecting payments a bit faster than Royal Caribbean, which Royal Caribbean ended up having an average of about 11.5 days in sales and receivables, while Carnival Corporation was at 9.75 days in sales and receivables.
So with that being said, next we're going to look at the sales and inventory, which indicates the average number of days it takes for a company to sell its inventory completely. Carnival Corporation has an average of 14.83 days, while Royal Caribbean has an average of 17.43 days. Therefore, once again, Carnival Corporation has the slight edge.
Overall, Carnival runs its operations a bit more smoothly, but both companies show they've streamlined since the pandemic showdown. Now this one's a big deal for the cruise industry. Say it with me, leverage.
Yes, exactly. Because cruise ships are incredibly expensive, and both companies took on massive debt to survive the pandemic.
Let's talk total debt ratio, which is how much assets are financed by debt. Carnival sits at around 0.85 and Royal Caribbean 0.84, both quite high.
Their times interest earned ratio tells us how easily they can cover the interest expenses. Carnival's bounced from negative numbers during COVID to about 0.95 in 2023. Royal Caribbean's rose even higher, around 2.1, showing slightly better earnings relative to their debt cost.
The story here, both are still heavily leveraged, but starting to rebuild their ability to pay interest comfortably as profits return.
And now, for everyone's favorite part,
profitability. Let's look at gross profit margin, net profit margin, return on assets, and return on equity.
Carnival's net profit margin jumped from deep negatives in 2021 to around 6% in 2023. Royal Caribbean, though, on the other hand, came back faster, actually, reaching roughly 12% in the same year.
That's crazy, because Royal Caribbean led again with return on assets hitting around 5% while Carnival was at 3%.
Crazy. And what about the return on equity? This is where it gets really exciting because Royal Caribbean reached 18% compared to Carnival's 10%.
So while both companies are profitable, Royal Caribbean is squeezing more return for each dollar of shareholders' equity, meaning investors might see them as more efficient operators right now.
Gross profit margin is the percentage of revenue remaining after subtracting cost of goods sold. Both are on the higher range, starting at around 20% and ending even higher at around 40% as they transition out of COVID. Overall, this means that both companies are experiencing efficient production.
So, Scarlett, what is the big picture here?
Well, I'm glad you asked, Chloe. Carnival has a stronger liquidity cushion and runs a tight ship operationally, but Royal Caribbean still pulls ahead in profitability and debt management.
Basically, Carnival is playing it a bit safer, while Royal Caribbean, on the other hand, is sailing towards higher returns, but also with using more leverage.
These numbers really tell a story of the two companies and how they're still kind of recovering, but charting in different courses.
In the next episode, we'll see how the market views these companies, their stock, their performances, their valuations, and what investors are betting on next from them.
Thanks for tuning in to Cruising Through the Numbers, the CruiseLine ShowDown.
Until next time.
Money talks, dirty cash, I want you, dirty cash, I need you, oh. Money talks, dirty cash, I want you, dirty cash, I need you, oh.